Good morning, everyone. So, today we are going to do working capital decision. I'll be a little slow in this video because I felt last time I was very fast. So, let me talk about working capital decision. So, what we have done till now in the balance sheet, we have taken the decisions about the fixed assets, which is known as the capital budgeting decision. We have taken the decisions related to capital structure, which is the liability side of the balance sheet. Now comes to the next part, which is current assets and current liabilities, which we call as a working capital. So let's see how we decide about the working capital in a firm. Here also we need to maintain one thing, the basic objective of the financial management, that is to maximize shareholder wealth will apply. Along with that, what is the basic objective of the working capital decision? That is to maintain the comfortable level of liquidity in the company. Okay, let's see. What do you How do you define working capital? So working capital will be managing current assets and current liabilities in the business. So what constitutes current assets? So current assets are cash, inventory, receivables. Current liabilities will be payables, accruals, and short-term debt. And just to assess that, how we will assess whether a company is managing working capital properly or not, we will look for the various ratios which we call them as activity ratio. So these ratios are inventory turnover ratio, creditor turnover ratio, debtors turnover ratio, and the liquidity ratios, which are current ratio and quick ratio. So let's learn about some of the concepts associated with the working capital. First one is the gross working capital, and gross working capital is level of the current assets. That means how much current asset a company requires to run its operations. Okay, so that we call as a gross working capital. Now, what is net working capital? Net working capital is some part of the current assets will be financed by current liability. Like you have maintained inventory in the business, but you have not paid to your suppliers. So they are payables. So payables are your liability. So part of the inventory which is there is being financed by the payables. So that we call it as a net working capital. How much over and above the current liability do you need in the current working capital? Can net working capital be negative? In many cases, we have observed in the companies that net working capital can happen to be negative. That means company is having more current liabilities as compared they are having the current assets. And why does this happen? This happens because company has taken, say, short-term debt, and for from the short-term debt they are financing their long-term assets. Is it a good or desirable condition? No, it is not a good or desirable condition, and we must avoid that kind of condition because the long run, in the long run, such company will have low survivability. Okay, so what do you mean by permanent working capital? Say the permanent working capital is the minimum working capital which is required in the company at all the level of time. That means to maintain the sustained level of operations, the minimum working capital which is required, we call it as a permanent working capital. And we will see further in the financing policies, mostly company tend to finance this permanent working capital from their long-term capital rather than from the short-term debt. Now, what is temporary working capital? So, due to the cyclic reasons, due to the seasonal changes, or maybe due to certain demand, eruption of the demand in the company or in the market, you may need to change your working capital. That means the requirement of the working capital may be either high or maybe low. Say if it is high, so that means you require additional working capital. If it is low, so that means you need to have a lesser working capital. So that working capital which is fluctuating, we call that as temporary working capital. Now, what do you mean by net operating working capital? As I said earlier in the net working capital, that the current liability includes my short-term debt also. Okay, so short-term debt is an interest-bearing liability. So when I am going to consider only non-interest-bearing current liabilities, we call that as a net operating working capital. So these non-interest bearing current liabilities are also known as spontaneous finance. So that means this finance is readily available to us without any cost. Okay, when I'm taking short-term debt or working capital loan from the bank or from the factor, we call that as an interest-bearing working liability, and that we call it as non-spontaneous finance. Now, what is cash conversion cycle? Now, cash conversion cycle is very important for us. Why it is important? Because it is the length of time between paying the working capital and collecting cash from the sale of the working capital. So that means, say you got the inventory or the goods or the raw material from your supplier or vendor on credit. You also sold it on credit. Now you will receive the money from your customers and then you will pay to your suppliers or vendors. How much time is actually needed so that cash which you have invested in the inventory, that is you are going to get it back? So that we call it as a cash conversion cycle. Let's understand cash conversion cycle in a more elaborate manner because we will be calculating cash conversion cycle. So let's understand it in a more detailed manner. So what is this? We receive the material. We call that as receive material. Then that you cannot hold on, keep on holding it on for a very long time. You cannot just say that, okay, to my suppliers that I will pay whenever my, customers are going to pay me back. You cannot say like this. So, number one, that raw material will enter into a manufacturing process. So there is going to be some inventory conversion period. Say in this particular case, example, what we have taken, the payment deferral period is 40 days. Okay. Inventory conversion period is 60 days. So inventory conversion period means this is the time on during which we will be working on the inventory to make it as a finished good. Now, you got the finished good and then you sold it off to the customer. That is going to take, say, another 60 days. So, how much time period total was there? 60 days plus 60 days comes out to be 140 days. So, out of, 120 days. So, this 120 days, out of these 120 days, 40 days period was was given by, or we had a breathing space due to our payables. So 120 minus 40 will be my cash conversion cycle. Okay, why does this cash conversion cycle is important for us? because for this much time period, I need to maintain the liquidity in my firm. This much cash, due for that much period, we must maintain the cash in that much cash in our firm. So this is known as the concept is known as the cash conversion cycle. Okay. So let's do one question for your purpose. Solve this. So this is Z Company Limited has an inventory conversion period of 75 days, average collection period of 38 days, and payable deferral period of 30 days. So what is the length of cash conversion cycle? It will be 75 plus 38 minus 30. So in overall, it comes out to be 83 days. Okay, thank you so much. So these are the exercises which you need to solve by yourself. Solve this. I'll share the solution of these two exercises with you. In the very first question, you are supposed to calculate the inventory conversion period, average collection period, and average payable period. Okay, so you can calculate the cash conversion cycle. In the second question, it is straight away given to you all the time periods and you can calculate the cash conversion cycle. Just try it once. Let's see what working capital policy the companies usually have in their company. So either will be it is going to be very restricted policy, it is going to be moderate policy, and it is going to be relaxed policy. And what do I mean by restricted, moderate, and relaxed? So we will define this in terms of sale upon current asset and current asset upon fixed asset. If my sale upon current asset is low, what do I mean by low? When it will be low? The sale upon current asset will be low when we are going to maintain that much level of current asset as much sale is required. Okay. And if when it will be moderate, when the level of current assets is going to be high as compared to the sales. So that means your inventory or the receivables are going to be high as compared to your this I'm sorry, then it is going to be low when you are maintaining this high level of current assets. When you are going to maintain equivalent level of current asset as compared to sales, so then it will be moderate or matching policy. When it is going to be high, when you are going to maintain less amount of current asset as compared to your sales. So that means that we call it as an aggressive or restricted working capital policy. I can define it in terms of current assets upon fixed assets also. When it is relaxed, relaxed means again my level of current asset is going to be high as compared to my fixed assets. And when it is going to be low, when my level of current assets are going to be low as compared to the fixed assets, and moderate is that. So that means in this case, this is going to be less than 1. Current sales upon current assets is going to be less than 1. In high aggressive or restricted policy, sales upon current assets is going to be greater than 1. And in moderate or matching, it is going to be equal to 1. In current asset upon fixed asset, moderate or matching policy, it is going to be equivalent to 1, equal to 1, almost equal to 1. High means relaxed or conservative policy, current asset upon fixed asset is going to be high, so that means greater than 1. And here the current asset upon fixed asset is going to be in the aggressive or restricted policy is going to be less than 1. Okay, how does it is going to affect my return on equity? And what do I mean by return on equity? Again, this is the criteria which we have, that is effect maximize the shareholder wealth. So this is how my working capital policy will be related to the objective of the financial management. So we all know DuPont chart. So how do we define return on equity according to the DuPont chart? It is going to be profit margin multiplied by total asset turnover multiplied by leverage factor. Okay. So we say net income upon sales, that is my profit margin, total asset turnover, sales upon total assets. Okay. So my leverage factor is asset upon equity. So my return on equity is going to be low in relaxed or conservative policy. It is going to be moderate in moderate or matching policy, and it is going to be very high in case of aggressive or restrictive. Understand this in a better way. Now, this is my criteria, that is current asset upon fixed asset. So say it is conservative when I am going to have it equal to 1 or greater than 1. It is going to be moderate when it is approximately 0.8, say close to 1, and it is going to be aggressive when it is going to be very, very less than 1. Now, what we have sales in both the companies in all the three cases is say 15 million. EBIT we have got 1.5 million in all the cases. Now let's see. Fixed assets we have decided to be 5 million in all the three cases. Let's be conservative, moderate and aggressive. So my working capital decision is current assets. So let's see. In conservative policy, the ratio is say 1. Okay. So how much current asset we need to maintain? 5 million. In this moderate case, fixed assets are 5 million and my current asset upon fixed asset is zero point 0.8. This gives me the level of current assets will be 4 million. In aggressive case, it is current asset upon fixed asset is 0.6, and with that if I calculate, my current level of current asset is going to be 3 million. So this gives me total assets of 10 million in conservative policy, 9 million in moderate policy and 8 million in aggressive policy. So my return on asset in this case, EBIT upon say total asset is going to be 15%. In moderate policy, it is going to be 16.67%, and in aggressive policy, it is going to be 15.57%. I think there is something wrong over here, but otherwise it is going to be highest in case of the aggressive policy, lesser in case highest in case of aggressive policy, lesser in case of moderate, and very low in case of the conservative policy. So let's say how we are going to, then first of all, what we have done, working capital policy. That means how much level of working capital a company should maintain. So we have learned three working capital policies: conservative, moderate or matching, or aggressive. Okay. So now how we need to finance this current assets or working capital. Again, we have three policies over here. So when three policies means conservative policy, aggressive approach, maturity matching or self-liquidation approach. Okay. Now these three depends upon how we are going to finance our permanent working capital and temporary working capital. So what we are going to do over here, in the maturity matching or self-liquidating approach, the permanent current assets are going to be financed from the long-term capital. Okay, so that means permanent current assets, long-term capital. Temporary current assets, that is going to be financed from the short term. So when I talk about aggressive approach means again, so part of the permanent current assets are going to be financed from the short term work short-term capital. So that means mismatch हो गया. So there is going to be mismatch in this case. That is, permanent current assets are going to be financed from the short-term debt or short-term finance. Conservative approach means even part of the temporary current assets are going to be financed from the long-term capital. So now you can understand the effect on the return on equity. It is going to be low in the conservative approach because you are financing from the a part of your temporary working capital, also you are financing it from the long term capital. So if you remember the term structure of interest rate, longer the maturity of the capital, higher is the interest rate. So interest rate is going to be high. That means cost of capital is going to be high in case of the long-term financing as compared to the short-term financing. So when you have taken financed the temporary working capital or temporary current assets from the long term capital, so that means your cost of capital will be high, your interest payment will is going to be high, there will always be some redundant capital, unused capital in the company, so cash you are not going to earn say much, so that means the return on equity is also going to be low. In the aggressive approach, it is going to be high. In the moderate or self-liquidating approach, it is going to be moderate. Let's examine the working cap effect of the working capital financing policy on the ROE. So this is a question. The company is examining use of short-term and long-term borrowing for its financing. Okay. Estimated fixed assets and current liabilities for the next year are 2.60 billion and 2.34 billion respectively. Okay. Investment in current asset is 3.90 billion. Okay. Estimated sales are 11.50 billion and EBIT is going to be 1.15 billion. Company will use rupees 2.50 billion as an equity. That is fixed. So corporate tax rate is 35% and here are the following debt alternative available to us. Now look here. The short-term debt is available at the rate of 12% and long-term debt is available at the rate of 16%. Okay. So in the conservative policy, we are going to have less than 1 from the short-term debt, more than 1 from the long-term debt. In the moderate policy, we are going to have matching principle. Say 1 million we are going to have from the short-term debt and 0.66 we are going to have from the long-term debt. And in the conservative policy, we are going to have 1.50 from aggressive policy. We are going to have 1.50 from the short-term debt and long-term debt. We are going to have 0.16. So let's solve this case. We have done this. Let's understand. Sales are going to be 11.5 billion in all the cases. EBIT is going to be 1.15 billion in all the cases. Current asset we said is going to be 3.9 million in all the three cases. No problem in all the cases. Fixed assets we said is going to be 2.6 in all the cases. So this gives me the total assets are going to be 6.5 billion. Okay, done, no problem. So now comes the question on the financing side. Financing side means the proportion of the long-term financing and the short-term financing. In the previously we did the question related to the short-term assets and the long-term assets. Now we are doing the questions related to the short-term financing and the long-term financing. So liability which we need is 2.34 billion in all the three cases. Done. This is going to be my current liability. Now let's see how we are going to finance this current liability either from the short-term debt or as a proportion of the long-term debt. Okay. Uh, Equity is going to be 2.5 billion in all the three cases. Okay. Short-term debt, it's being given 0.54, 1, 1.5. Long-term debt is 1.12, 0.66 and 0.16. So debt ratio, let's see, debt upon total asset is going to be same in all the three cases, which is going to be 0.25. Okay, let's see. The interest for the short-term debt. So that means 0.54 multiplied by 12% comes out to be 0.06 billion. Here 1 multiplied by 12% comes out to be 0.12 billion. Then here 1.5 multiplied by 12% comes out to be 0.18 billion. Similarly, I can calculate the interest on the long-term debt also. We know it is 1.12 multiplied by 16% comes out to be 0.18 billion. So my profit before tax. So profit before tax will be EBIT minus interest. Interest will be these two, sum of these two. Okay. So that means EBIT is 1.15, 1.15 minus 0.06 minus 0.18 and it comes out to be 0.91. So tax rate was 30 or 35%. Okay, so I have calculated minus tax, it comes out to be my PAT. So I can calculate my return on equity, which is PAT divided by equity capital. So let's see where the PAT is high, ROE is high. So my ROE is highest in case of the aggressive policy. It is going to be lowest in case of the conservative policy, and it is going to be moderate in case of the moderate policy. So you may suggest that every time we should follow the aggressive policy because it is going to give me the better returns, highest ROE, whether I am going to have the working capital policy or working capital financing policy. But this is not the case. You are not only you are not supposed to manage only and only return. You are supposed to manage the risk also. And what is the risk in the aggressive policy? The risk in the aggressive policy is that number one, you are going to raise funds from the short term and you are going to pump this into the fixed assets. Okay, so that means you have fixed, you know, I mean your short term debt is going to be say, going to finance the long term asset. So this is asset liability mismatch. And why it is a mismatch? Because suppose you have created fixed asset out of your short term debt. Short term debt means there is going to be quick repayments. So what if your sales are not good? So that means you will not be able to make the quick repayments. Though you are able to lower your interest payments, but then the risk will be again, don't forget the effect of the leverage which we have done in the capital structure. At any point of time, if you need to repay very quickly, so that means if the sales are bad in some point of time, so that means our repayment capacity will be low. So that is the risk which we will face over here also. Okay. Done in the supply chain management, the ways by which the firms manage their inventories. Okay, this is a very important question in our current asset. Since all these are related to the operations part, so I'm not including it over here. What we are supposed to understand is how we are managing the cash, how we are financing the inventory. Okay. Let's talk about the account receivables. Account receivables means this is another current asset with us, and we call that as a credit policy. Similarly, similar to this, we can have the payable policy also. Okay, so credit policy and payables policy both are similar. Only thing over here is if you are a big company, then your payable policy, you can dictate the payable policy, you can devise a payable policy. But if for a very small firms, taking decisions about the payable policy is not that effective. Effective means they cannot ask the suppliers or the vendors to follow their payable policy. Rather, they need to follow the payable policy of their suppliers or vendors. Similarly, for the credit policy also, for the very small firms, sometimes it is not possible for these firms to, have the negotiation for the credit policy, and they need to follow the, receivable policy, which the bigger companies dictate them. Okay, so what are the components of the credit policy? The components of the credit policy are: number one, credit period; number two, discounts; number three, credit standards; and number four, the collection policy. So when I say credit, uh, okay, I'm just going to show you something. So credit policy is the time buyers are given to make the payment. Time buyers are given to make the payment means, suppose I have given 30 days to the, to the my customers. Okay, so if I have given 30 days to my customers, so what does this mean? So this means the customer is going, on an average, is going to repay me back after 30 days. So how it is going to affect my financial condition? Okay, my company's financial condition. So you must understand over here, longer the credit period, the more can be the bad debt. But shorter the credit period can reduce your sales also. So this is a double-edged sword. So if you are going to have a relaxed credit period, it may result in bad debts. And if you are going to have shorter credit period, it may reduce your sale. Discounts. And what do you mean by discounts? The reductions given for the early payment. Now, this is different from the trade discount, and you must appreciate the difference between trade discount and the cash discount. Okay, so what do you mean by trade discount? Trade discount is which we generally give, say, the price of the good is say 50 rupees, and I have given a discount of 10 rupees on that. So my selling price is going to be 45. So my invoicing will be at the rate of 45 only. But what do you mean by cash discount? Cash discount is the discount which we give when, say, you pay me cash upfront. So 45 rupees you are supposed to pay. So you pay me cash upfront, or within a day, I will give you another discount of 10%. So 45 ka 10% comes out to be 4.5. So 4.5 means the person need to pay now 40.5, 40 rupees 50 paisa. So that we call it as a cash discount. So what is the effect of this on our finance? So the effect will be discount is the cash flow. So that means when I am giving the discounts, I may get a quicker cash, but it may result in the reduction, and they may also result in the reduction of the bad debts. But what is the downfall? We are receiving, lesser cash. See, I have received rupees 4.50 paisa lesser as compared to the one which I was supposed to get. Okay, now credit strength standards. Now, what do I mean by credit standards? So that means required financial strength of the customer to offer credit. So what do firms do? The firms need to check the customer's history, its debt, and its interest coverage ratio. Say, I cannot give the same credit period to every customer. It will depend upon, number one, the credit history of that particular customer itself. how they have, very how much quickly they have returned our money back. Number two, what is their standing in the market? How good is their interest coverage ratio? What is their debt level? If their debt level is very, very high, one downfall in the sales, so that means they are not will not be able to pay us also. So credit policy is just like that, you are going to give finance to the another company, okay, and that is spontaneous finance, remember. So you are giving loan to the other company in the form of goods, so it depends upon how they are going to return you back. And if the company has a higher debt and interest coverage ratio is also not good, is very, very low, so that means they will not be able to repay back my amount. So that means these are the credit strength. Say, if I'm going to have the lower credit standards, so that may result in the bad debts, and may my it may result in the loss in the sale also. Okay, but bank guarantees, factoring services, they are usually ways to strengthen the credit standards for the companies. Okay, so what is a collection policy? Collection policy is the procedure which we are going to use to collect the amount due. What do I mean by that? Say I'm going to send a reminder mail, or I am going to give to the factor. Factor, what is this factor means? These are the specialized financial institutions who are involved. They buy the account receivables from the company, and on their behalf they collect the funds from uh, the another customers, okay, from the customers. So here also we have a various type of factoring services being available. One is recourse funding, another is a non-recourse funding. I will not go detail into this, but for your knowledge, for your simple knowledge, at times the factor, we are going to sell our account receivables to the factor without any guarantee. So that means factor is going to bear the loss if at all there are going to be any bad debts. So factor is going to charge higher commission in this particular case. So in another case, factor is not going to take charge of the bad debts. So you are the guarantor. The factor will give you the money, but in case there is a bad debt, you need to own that bad debt. The firm needs to own that bad debt, and they need to provide the funds to the company, the factor. Okay. So that means factors risk is reduced over here. So if factors risk is reduced, means they will provide less, they will provide more funds, or they will charge lesser fee for that. Okay. So if we are going to have stringent collection policy, so that may be that we may be able to collect faster money, and simultaneously that may also result in loss of sale, because people may not like to buy things from you. Okay, next is, say, if I'm having relaxed collection policy, so that means it may result in the delay in payments, again a loss. So at every point there is a trade-off between loss in the sales, loss in the customers, versus the loss due to bad debts. So it is again, I say, it is a double-edged sword. You have to tread that path very carefully. Okay. Let's talk about the spontaneous finance for the current asset. We have already done this. So what do you mean by account payables? So this is the trade credit. Trade credit means, as I already we talked about, that your the just like we are going to give finance to our customers, we may also get finance from our suppliers. So that, what does this mean? This means that stretching the account payables. Stretching the account payables means that if you are supposed to pay in, say, 10 days, you may pay in 15 days. What are the side effects of this? Side effect of this may be that no company would like to supply you the material. Okay. But then again, it depends upon the negotiation power of that particular firm. Okay. This all is going to affect my cash conversion cycle. Now, the level of cash which we need to maintain in the company. Another is the accruals. Accruals are like you pay to your employees monthly, weekly, or fortnightly basis. Okay, you pay your electricity, firm pays your electricity bill at a say monthly or weekly or fortnightly basis, and maybe the other utilities bills at that point only, but they are using that every day. Generally there is lag in the payment of 1 month to 45 days in such cases, and we call that as accruals. And that also is a spontaneous finance because you are using that without paying that. Okay, so what are the non-spontaneous finance for the current assets? And this is will be very much of your interest. Number one is the overdraft. And generally we are going to get either this from the factor or from a factor is one financial institutions, either from the financial institutions or from the bank or even from the market. So three sources we have got. Number one, bank. Number two, financial institutions other than banks. And number three, market. So first of all, I'm going to explain about the banks, and number two, I'm going to explain you about the market, and number three, I'm going to explain you factor. Factor we have I have explained it at length. So number one, the finance or the loan which we can get is the overdraft. Overdraft means the firm maintains current account with the bank. Okay, so within the current account, the bank is going to allow you to withdraw from the current bank over and above what you have deposited. Okay, but within a limit. So that limit we call it as a overdraft. Okay, now what is cash credit? Now overdraft is that it need not to have any collateral, need not to have any collateral of the current asset. Now, cash credit means here it is similar to overdraft. Bank is going to give you the facility of cash withdrawal, but this money will be against the security of a collateral, and collateral over here is either going to be inventory or going to be the receivables. So generally you might have heard firms talking about overdraft limit and the cash credit limit, and that is why these two limits are different. Overdraft is not backed by the collateral, whereas cash credit is backed by the collateral. Okay, I'm just giving you the broader categories. When actually we are working about the working capital finance from the bank, there are very finer divisions also. Okay, so talking about the working capital demand loan. Again, this is a short-term loan with fixed repayment schedule. Now, this is a kind of a medium term loan. Medium term loan, I should not call it as a medium term loan. It is less than 1 year only, but the repayment schedule is fixed. When we are talking about the overdraft or the cash credit, generally the time period for which this overdraft and cash credit is given is say 20 days, 30 days, or maximum say 40 days, depending upon your cash conversion cycle. Okay, but the working capital demand loan is the repayment schedule is little longer as compared to overdraft and cash credit. And what do you mean by bill discounting? Bill discounting is again on the receivable. So the suppose you have sold the product to your customers. So immediately they are not going to give you the cash payment. So what they are saying, they are acknowledging or giving you the bill. That is, this bill recognizes that you have sold off the items to them, and then they are going to repay back you after 40 days. But then you require finance right now. A firm requires finance right now. What it will do? It will go to the bank and will produce that bill to the deposit that bill to the bank. This particular bank, the company A's bank, will talk to the company's B's bank, and behalf of the company B's bank they are going to provide, the company A's bank is going to provide the loan or financing to the company. Okay, this bill discounting has been a very much controversial kind of instrument, and that is why these instrument is not in very much use in these days. Okay, now comes the export and import. For particularly for export and import, there are different kind of credits being available. One is this DA, DP, packaging credit, EP, uh, EBPD, EBC. Okay, I will not go too much into the detail. One is documents against acceptance, documents against processing, the packaging credit. I will share one brief document with you, which is going to explain this DADP, packaging credit, EBDP, EBPD, and EBC. But you need not to go too much into details, because that will be something which we are not going to do in this particular subject. Now, after the banks, I'm talking about the commercial market, and that is commercial paper. Commercial paper is a short-term bond raised from the market. The companies can raise funds from the market by issuing the commercial paper. This is usually for the 1 year that company is going to raise fund from the market. Factoring I have already explained. Now, we are going to do this in detail, and I'm going to give you the some exercises based on the estimation of the working capital. So first of all, current asset holding period, that is we are going to compute how much we current asset and current liability we are the company is going to hold, and based on that we are going to estimate the requirement of the working capital in the company. Since most of you will be going for the internship after this, is say in a bank or any other financial institution, so most of the times the banks require to this as a document to assess that how much is the requirement of the working capital in the company. Another method which is there is a ratio of sales method. This is very rudimentary method, very rudimentary method. Say company is having sales of 20 million. So now if say net working capital is going to be 25%, as we have done in the capital budgeting, so my working capital net is going to be 20 multiplied by 0.25, that is 25%, and comes out to be 4 million. This method we have done in the capital budgeting, and current asset holding period we are going to do in detail. And same thing can be applied when we are going to estimate the working capital even in the capital budgeting decision. Okay. And the third method is ratio of fixed assets. That is, bigger the company, higher is going to be the requirement of the working capital, because they are going to produce more. So what do we do over here? Say we decide that the net working capital requirement is going to be 20% of the fixed assets. Okay. So fixed assets are say 5 billion, then the working capital is 20% of the 5 billion, and it comes out to be 1 billion.